Welcome everyone, this is Navdeep Dhaliwal, CEO of Supreme Cannabis, and would like to thank you for taking the time today to listen into an investor update on the company. Please take the time to read some customary disclaimer language for the presentation. So first of all, I think it's important to recognize what drives us as a company. We're really a company driven by a strong mission. As a company, we believe in the immense positive impact cannabis can make globally. And when we say positive impact, this is an impact on the lives of patients, consumers, employees that are building a career in this new and growing industry, and the sheer business and investment opportunity it offers as a new and exciting industry. So as a company, we're really focused on producing high quality products with a brand promise that delivers what the consumer is looking for, and how we summarize that overall is a positive experience. In fiscal 2019, we took a very simple approach to our business, understanding that we are in the early innings of a brand new industry that we have to build from scratch. So step one is really to build out the infrastructure to produce the products that we believe will be competitive. And the key thing is building infrastructure that produces high quality products for the long term and not rushing it to produce uncompetitive products. So second is we always take a consumer-centric approach, and taking that approach to build lasting brands that stand for quality. So an example of that is 7 Acres, which is a 2-time Brand of the Year award winner. And lastly, to be successful at both of these aspects, you have to have a passionate and strong team that is committed to this mission. And over the year, we've continued to attract top talent and continue to build this team for the long term. Our simple approach to our strategy in fiscal 2019 also resulted in strong financial performance. And the key thing is this is strong financial performance in the first year of this industry. That resulted in 370% revenue growth year over year, but including our most recent quarter, which was a decline quarter over quarter, we're still averaging over 30% quarterly growth. In the first year, we earned over $41 million in revenue, but I think a key milestone for the company was fortifying our balance sheet by raising $100 million, which at the moment in a very challenging capital market really sets us apart from others in the industry being well capitalized. Going forward, we're going to implement the same simple strategy, and that includes having focused infrastructure, creating centers of excellence from a production standpoint, ensuring to stay focused on the consumer by building consumer-driven brands that really resonate with the consumer, and continuing to build a passionate culture and a really experienced team to execute on this strategy. And we believe this simple strategy is the path to profitability in this industry for our company. We're in an industry where world-class commercial infrastructure has never been built before. There's no examples, and we're really building everything for the first time and from scratch. So Supreme Cannabis builds its operating assets with the goal of creating centers of excellence. Each of the company's facilities are built with the best-in-class features and operated by skilled professionals who are experts in the facility's core capability. So as you can see, we're really building a national footprint to power our business for the future. So first of all, I want to touch on our core asset, which is our cultivation facility in Kincardine, Ontario. The key thing to remember is this is a purpose-built facility, and it was purpose-built to produce quality flower over the long term. And this is where we focused all of our attention at the outset, and that's because we believe cultivating quality cannabis at scale is a foundational skill set. So over the last couple of years is where we've really gone through a lot of our challenges and scale-up challenges, and we believe this is what really sets Supreme Cannabis apart, because most of the industry, or a lot of the industry, is just starting to encounter scale challenges now, which we believe is the most difficult aspect of this industry at this stage. So that's what we've already gone through. We're completing construction at the end of this year, and this facility has been proven to produce a high quality product, and now we're focused on optimization and building out other areas of the value chain. So this year, we also added extraction to our infrastructure portfolio. This was a great acquisition for our company because it added diversification to our flower business, and we bought a pretty much already built extraction facility, which we then expanded to add ethanol extraction at scale. So the exciting aspect of this piece of infrastructure is we're adding diversification, but also it allows us to quickly move into new derivative products that will start contributing to earnings fairly quickly. So this is a project that over the last 5 months we've acquired, we've revamped, expanded via construction, and we already have products in the market. So next I'm going to touch on our manufacturing operations. And this I know is probably going to be quite new to most investors. We just recently announced this facility to the market. So the purpose of Kitchener is really to address what we believe is going to be a huge gap in the value chain in this industry. As we see increasing supply across the market, increased demand for new products and manufactured products, we believe Kitchener is going to play a key role for our business, but also take advantage of what we think is a huge market opportunity. And that's being a manufacturing, processing, and packaging partner for other flower producers in the industry. In the near term, this is where we'll centralize our CPG operations in terms of packaging flower and distributing it to the market. We'll also scale out the manufacturing of our pre-roll and other flower convenience products, and also bring in-house the production of vapes and concentrates. In the long term, what it really provides us is the ability to expand our business by working with third-party flower producers and providing them packaging and distribution. Also, it provides us a lot of flexibility to move into new and exciting product categories that we see a demand for in the market. In fiscal 2019, we also added a key research and development asset in Scarborough, Ontario. This came to us via the acquisition of Truvera. Short term, this allows us to immediately produce new Cannabis 2.0 concentrate products such as hash and rosin. And we believe we have a competitive advantage in this product category because it requires high quality flower input, and we plan to be a strong competitor in this product segment. Long-term, given the analytical lab infrastructure we have, this will allow us to innovate for new medical products and new cannabis health products and experiment with other new product categories. So next I'll talk about our international investment. So approximately a year and a half ago, we were connected with a company within the borders of South Africa in the Kingdom of Lesotho, which ran a company called Medigrow, now renamed MG Health. As a company, we believe that cannabis oil will commoditize over the long term. So this is a long-term investment we made in exchange for 10% equity interest, but access to long-term cost-advantageous supply, which we can use in products for international markets. So as the industry matures, our view is that long-term value will be driven by consumer-driven brands. And the reason why we focus so much on having quality infrastructure is so we can produce high-quality brands that will be valuable long-term. Over the year, we assembled quite an impressive portfolio of very focused consumer brands. So currently, as supply increases in the market, our primary focus is the recreational market in Canada, with our strong consumer-facing brands. The reason why we focus on the recreational market is we believe the recreational market in Canada is protected from international pressures from import, given that you will not be able to import for recreational purposes. The reason why it's important to transition to consumer-driven brands is because that's what will protect margin. The trend of margin protection driven by brands is a trend we've seen in other markets, primarily California in the US and other maturing US recreational states. During the year, we made significant progress to transition into a fully CPG company. And in our most recent quarter, we generated margins of approximately 63% from our branded CPG products in the Canadian recreational channel. Now that we've established 7 Acres as a leading premium flower brand, we'll expand that to other consumer segments as well. In addition to that, we've over the year added very focused brands. So first of all, we acquired Blisco. We acquired Blisco because we believe the emerging wellness consumer is a very large market, and this also includes the emerging CBD consumer. So Blisco has a very premium positioning as well, and over the year we've sold pre-rolls under this brand and now have come to market with premium cannabis oils, primarily CBD to begin. Over the year we also acquired Truvera. Truvera is our internationally facing medical brand. This is the brand we go into international medical markets with and will produce medical products. At the moment, we produce CBD products which are sold in the UK and the Netherlands. During fiscal 2019, we also established KKE. KKE is focused on cannabis enthusiasts and is a partnership with Khalifa Kush Enterprises. Khalifa Kush Enterprises is a company out of the US which is focused on premium cannabis products catered towards enthusiasts, and we're bringing that same ethos to the Canadian market. And one of our most recent brands is Sugarleaf. Sugarleaf is positioned to target the convenience consumer. So you're going to see many products under this brand, such as pre-rolls, oils, and vape pens. So as we go into fiscal 2020, we believe we put together quite an exciting brand portfolio that hits on many consumer segments. And over the year, we'll look to build out these product portfolios. And as we did with 7 Acres, really establish these as dominant brands in the consumer segment that they participate. So many questions we get from the investment community is why we don't have a edibles and a drink strategy. Well, the answer is fairly simple. It's deliberate. At the moment, we don't see edibles and drinks being a very large market that you can differentiate yourself in within the Canadian market. The fact is, edibles and drinks will be driven by distillate inputs, which are going to be and are quickly becoming the most commoditized aspect of the cannabis industry. And in a market where it is challenging to differentiate yourself from a packaging perspective and a branding perspective on the shelf, we don't see this as an exciting category to differentiate ourselves as a company and differentiate our brands. Rather, we've focused on what our core strength is and what we believe is still today and in the future to be the largest aspect of the market, and that's the whole flower-driven market. So our brand portfolio is really focused on flower, flower convenience, and flower concentrate products, with our primary 2.0 product being vape pens. And when it comes to vape pens, we believe and are quite confident in our strategy and our partnership with PAX, because we believe that will create differentiation for our vape products in an industry that is going to be proliferated with many vape products and is going to be hyper competitive. Therefore, we believe our partnership with PAX really sets us apart. So as the industry and as a company, we transition into a CPG company. You can see this in our financial and operating results as well. So as you can see, quarter over quarter, over the last 4 quarters, we've averaged a 33% growth rate. However, you can see also a decline in our most recent quarterly results. And this is an overall industry trend in terms of as the industry faces issues in terms of increasing distribution, etc. But I think a key positive milestone for our company is the next step in terms of our branding and product strategy. So during the quarter, we launched one of our most recent and new and exciting strains, Jack Haze. So this is an example of a strong product launch with a strong brand and a strong marketing campaign. And the result of it has been that Jack Haze is now our highest average selling price product, and it's a product that retailers cannot even keep on the shelf. So again, an example of the power of brands and the importance of brands moving forward and how they're going to impact financial results. And so going back to the industry headwinds that we're all facing in this inflection point in the industry where we believe capital is being sucked out of the market, and now it's the strength of your business and your brands that are going to set your company apart. We also, in the most recent quarter, announced a $90 million credit facility led by a Tier 1 bank, BMO. But I think another key thing here was we were the first company post compliance issues in the industry to obtain a Tier 1 credit facility. And that required very rigorous third-party audits of our facility and our compliance practices and adherence to the regulatory environment. So I believe the main takeaway from the credit facility investors should focus on is that, number one, we are capitalized during a very challenging time in the industry and positioned to be emerging as one of the winners. Number two is investors should have lots of assurance in terms of our operation and adhering to regulatory requirements, given the rigorous process we went through to obtain this credit facility. So now looking forward to fiscal 2020, we're quite confident in the forecasts of our business. And the reason why we have this confidence is because of our focus. Again, we continue to focus on what we believe are the largest portions and the most certain portions of the market. And again, it's leveraging and continuing to build on our core strength. So our focus and our forecasts are really driven by our whole flower business, our whole flower convenience business, and a very focused strategy when it comes to 2.0 products, focusing on vapes via our partnership with PAX, and focusing on concentrate products, which are a direct representation of the quality of the whole flower inputs. So again, we're very confident in our revenue forecasts because they are driven by products we know very well, and we've already proven to have a competitive advantage in the eyes of the consumer and been proven to be able to build strong brands around these products. So entering fiscal 2020 with already a strong team, we've continued to attract top talent. And I think that's a key point to note for investors, because as you've had capital retract from the industry, you've also had energy of people retract from the industry. So I think it's a very positive sign for our company and its long-term prospects that we continue to attract very senior and very talented people to the company as we build out our business. Furthermore, as we transition to a CPG company, our company is becoming quite sophisticated and quite a large enterprise. And early in fiscal 2020, we've added key additions such as John Grease as our Chief Operating Officer. John comes with approximately 30 years in the CPG industry with companies such as Frito-Lay, PepsiCo, and Nestle, but more importantly, also comes with several years of experience in the U.S. cannabis industry. So this provides a CPG and cannabis experience, but looking ahead also provides us with operating experience in the U.S. as we look to that market for future growth. Also, another key addition has been Joel Taguri, our new SVP of Commercial, who joined us from a large licensed producer in Canada and now leads all revenue aspects for the company and has been a key addition as we look to scale revenue significantly. Also joining us recently was Ash Rajendra as Chief Information Officer. Ash joined us from a New York Stock Exchange listed company where he was also CIO. Lastly, we also added Valerie Rother as VP of Talent. As we continue to attract talent, and what we see as a core strength being our people and culture, it's becoming even more important to maintain this culture and retain and attract further talent as we continue to build our business. And supporting our management team is a strong board focused on governance, but also more importantly for our business is very active in terms of providing oversight and guidance. So as I conclude the presentation, I believe as a company, we've established a very strong foundation. We have a very high caliber management team, which we continue to mature. We've completed significant world-class infrastructure, and we've proven that we can build market-leading brands that are backed by product quality. Now, as we look forward, we believe we're poised for strong growth on top of this strong foundation as we continue to diversify our infrastructure portfolio, as we continue to introduce new brands and new products, and we have also fortified our balance sheet with a credit facility in the most recent quarter. So we believe we're positioned very well to make it through the headwinds the industry is facing currently, but more importantly, emerge as a winner in the Canadian market. And from there, based on strong financial performance, pursue international growth objectives. So lastly, as I conclude the presentation, I would like to thank everybody for taking the time to learn more about our company, get updated in terms of our current positioning and the exciting growth ahead. And as always, if you have further questions, please reach out to our investor relations team. Again, thank you very much for your time.